Our next theme on the global equity market is that the bar is set too high. The rally that we saw at the end of last year, in our opinion, is most likely borrowing from some of the returns that we're going to see this year. We still think that you can have a positive year for equities, but we do not expect the same level of PE expansion, nor do we expect the same level of returns for the equity market. We think it's going to be more muted this year as we look at valuations. And if you look at this chart, you can see that the risk premium or the earnings yield over the 10-year Treasury yield, this is at the lowest level we've seen. You got to go all the way back to the dot-com bubble. It's well below average, and this is showing that equities are simply too expensive at levels right now. We think it's pricing in perfection across the board. What we expect is that the tech rally we saw last year, that's going to be tested this year. We realize that technology and artificial intelligence is a long-term theme, but what are you willing to pay for that? We think the valuations right now are just too high. We'll wait till we see a pullback in some of those tech growth names before we would add any exposure. From a global equity recommendation, we'd be neutral. We don't want to sell into this rally because we are constructive long-term on equities. We'll get out of this economic weakness. And this pullback in the economy, it's healthy, it's warranted, and we need it to get inflation under control. But what we would rather do is wait and see when there's better opportunity and you're being rewarded for that risk. And the chart I just showed you shows you're not being rewarded at levels right now. Now, there are areas of the equity market that we think can benefit when you come out of a recession. When you look at this chart, you can see that small and mid-cap stocks do better. So we'll be looking at opportunity to add to those areas. Developed international, it has been lagging the U.S. market because it's not a tech-heavy index. So when you look at valuations, they're historically cheap. We'll be looking at opportunities as well to add to those developed international parts of the market. Now, we still do have a lot of dry powder sitting in portfolios, and that's crucial this year. We think there will be volatility. It is a presidential election year. We have interest rate uncertainty. We have economic uncertainty. We have geopolitical uncertainty. All these things make it very valuable to have cash to put to work. So we're going to sit neutral our global equity exposure for the time being and have that dry powder to put to work as we find those opportunities.